Let's talk about America's money, and more importantly, its long-held reputation in the world of finance. We're not just talking about the physical dollars and cents, but the entire financial ecosystem that the United States has cultivated over decades. For decades, the U.S. was the world's financial safe haven, a beacon of stability in an often turbulent global economy. It was the place everyone looked to when uncertainty loomed. It was the place where everyone stashed their savings when things got rough, trusting in the strength and security of the American financial system. Like a modern-day Fort Knox, but for the world's wealth. U.S. assets were the safety bar on the global economic roller coaster, providing a sense of security amidst the ups and downs of the market. They were seen as reliable, sturdy, and trusted, a cornerstone of international finance, offering a predictable return and a safe store of value. Whenever crisis struck, no matter the origin, be it a coup, a currency crash, sending shockwaves through a nation's economy or a natural disaster, devastating communities and economies alike. Investors, both big and small, invariably flocked to U.S. dollars, seeking shelter from the storm. Stocks and bonds, confident in their long-term stability and value. This wasn't just habit, it was a core principle of global finance, deeply ingrained in the strategies of investors and institutions worldwide. The U.S. was seen as too big, its economic engine too powerful to be significantly impacted by global events. Too stable, with a government and central bank that were perceived as reliable and predictable. And too important to fail, a sentiment that was perhaps tested but ultimately reinforced during the 2008 financial crisis. Its economy was massive, a sprawling landscape of innovation and production. Its military unmatched, projecting power and influence across the globe, and its institutions rock solid, providing a framework of laws and regulations that fostered confidence and stability. American exceptionalism wasn't just a slogan, a patriotic rallying cry. It was a calculation made by investors worldwide, a rational assessment of risk and reward. But lately the world is starting to question if the U.S. is still the safest place for their money, and whether that long-held perception is beginning to erode. The idea that America might not be the ultimate safe haven anymore is a seismic shift, a potential paradigm change in the global financial order. And as we'll see, this shift is already happening, subtly reshaping the landscape of international investment, with real consequences, impacting everything from currency values to the flow of capital around the world. America's financial dominance, for decades a seemingly unshakable force, rested on three mighty pillars. These weren't just abstract concepts, they were the very bedrock upon which the nation's economic power was built. They represented the core strengths that allowed the U.S. to project its influence across the globe. First, relentless economic growth, a perpetual engine of prosperity that fueled innovation and opportunity. This wasn't just about incremental gains, it was about a dynamic, ever-expanding economy. Powered by innovative companies, from tech giants to nimble startups, constantly pushing the boundaries of what's possible. These companies were the driving force behind America's economic dynamism, and a booming stock market where fortunes were made and lost, reflecting the nation's economic health and attracting investment from around the world. The stock market served as a barometer of confidence and a source of capital for further growth. Second, the almighty U.S. dollar, the undisputed king of currencies. The world's reserve currency, the currency of choice for international trade and finance, a symbol of American economic might. Used in nearly every major transaction on the planet, from oil deals to manufacturing contracts, solidifying the dollar's central role in the global economy. This exorbitant privilege, as it's often called, let the U.S. borrow cheaply and weather global storms, providing a crucial safety net during times of crisis and allowing the nation to invest in its future. Third, trust in U.S. institutions and the rule of law, a cornerstone of stability and predictability that attracted investors and fostered innovation. Investors believed contracts would be honored, providing a level playing field for businesses and individuals alike. property protected and debts always paid, ensuring the security of investments and fostering a climate of confidence. These pillars reinforced each other, creating a virtuous cycle of prosperity and influence. Creating a self-sustaining cycle of confidence and investment, attracting capital from around the globe and fueling further economic expansion. The U.S. became the undisputed center of the financial universe, a magnet for talent, capital, and innovation. But as of July 2025, each pillar is showing deep cracks, raising serious questions about the future of American financial leadership. Growth is faltering, raising concerns about long-term economic stagnation. The dollar's dominance is under threat as other nations seek to challenge its supremacy. And trust in U.S. stability is eroding, undermined by political polarization and institutional dysfunction. The foundation of American exceptionalism is shaking, threatening to undermine the nation's economic power and global influence. The world is watching with a mixture of concern and anticipation, and starting to look for alternatives, hedging their bets against a potential decline in American power. The question is, what happens when those pillars start to crumble? What will be the consequences for the U.S. and the global economy? For years, the U.S. had a perfect credit rating, a gold star from every agency. But in 2023, Fitch downgraded the U.S. for the first time, citing ballooning debt and political dysfunction. Moody's soon followed with a negative outlook, warning of more downgrades if things didn't improve. These agencies, usually cautious to a fault, were now openly questioning America's financial management. The result? Higher borrowing costs for the U.S. government, billions more in interest payments. That's money lost to debt instead of roads, schools, or research. Under the second Trump administration, the response wasn't reform, but doubling down on risky policies. Protectionism, unpredictable announcements, and political infighting only deepened concerns. The world saw a country undermining its own credibility. The first tremors of lost trust were now shaking the global system. If credit downgrades were a warning, the Trump administration's new tariffs were a full-blown alarm. In 2025, Liberation Day tariffs hit nearly all imports, aiming to protect U.S. jobs. Instead, they triggered chaos in global trade, the very system America built. Investors panicked, selling off U.S. stocks, bonds, and even the dollar. For the first time, everything with a U.S. label was seen as risky. The protectionist push hurt America's biggest companies, which rely on global supply chains and markets. The U.S. went from global stabilizer to disruptor. Investors now saw America as the storm, not the anchor. The engine of American growth sputtered and trust eroded further. The pillars of financial dominance looked dangerously unstable. The world was no longer sure it could count on the U.S. What's the surest sign that something is deeply amiss in the financial world? What indicator flashes red, warning of impending economic storms? It's when investors, both big and small, start fleeing U.S. assets all at once. A mass exodus, a stampede for the exits. In 2025, we witnessed a synchronized decline. Stocks, bonds, and the dollar all sold off together, a coordinated retreat from American markets. It wasn't just a market correction, it was a crisis of confidence, a deep-seated unease about the future. This wasn't just a correction, a temporary dip that markets often experience. It was a vote of no confidence in America's future, a resounding rejection of the prevailing economic narrative. Central banks and institutional investors, the heavyweights of the financial world, once heavily invested in the U.S., began diversifying away, strategically shifting their assets to other markets. They reduced holdings of treasuries, the bedrock of global finance, and shifted capital to other regions, seeking stability and growth elsewhere. The result, higher borrowing costs, making it more expensive for businesses and individuals to borrow money, a weaker dollar, eroding purchasing power on the international stage, and rising inflation at home, squeezing household budgets and diminishing savings. As more people sold, driven by fear and uncertainty, U.S. asset values fell further, creating a downward spiral that was difficult to arrest. fueling a vicious cycle where falling prices led to more selling, which in turn led to even lower prices. The panic room was on fire, alarms blaring, and everyone rushed for the exit, desperate to salvage what they could. This was no longer a theoretical risk, a distant possibility discussed in hushed tones. It was the new reality, a harsh and unforgiving landscape. The pillars of growth and trust were collapsing one by one, dragging the dollar down with them, diminishing its global standing. The world's financial center, the heart of global capitalism, was losing its grip, its influence waning as other nations rose. Investors were searching, desperately seeking for new safe havens, alternative investment destinations that offered stability and growth potential. The era of Buy American in a crisis, the long-held belief that the U.S. was the ultimate safe haven, was over, signaling the end of an economic era. So where does the world's money go when U.S. assets aren't safe? Increasingly, central banks are buying gold, lots of it. Gold is timeless, tangible, and not tied to any government's promises. This isn't just about returns, it's a move to reduce dependence on the dollar. As trust in U.S. debt and the dollar fades, gold becomes the ultimate hedge. The price of gold has soared, reflecting a global search for safety outside the American system. Countries are also trading in other currencies and building reserves in euros or yuan. This de-dollarization is accelerating as nations seek to reclaim economic sovereignty. The world is building a financial safety net that doesn't rely on the U.S. The shift is as much about power as it is about money. If money is leaving the U.S., where is it going? Europe, especially Germany, has become a surprising safe haven thanks to relative stability and pro-growth policies. European assets now look like bargains compared to volatile U.S. markets. Investors are also eyeing Asia and emerging markets, where risks seem more manageable than America's political chaos. Countries with sound fiscal policies and open markets are attracting capital. The global investment landscape is becoming more competitive. The U.S. is now just one option among many, not always the most attractive. The world is moving toward a multipolar financial system. Investors are shopping around, no longer defaulting to America. The old monopoly on global capital is over. America's dominance is fading, but there's no clear replacement. The euro has its own problems. Political divisions and no unified fiscal authority. China's yuan is tightly controlled and trust in its markets is low. Gold and baskets of currencies lack the scale to anchor the global system. So the world is stuck in limbo. The old king is exposed, but no heir is ready. The result is a fragmented, volatile financial landscape. No single country or currency can fill America's shoes. The trust that held the system together is evaporating. The world is more uncertain and more dangerous than ever. Why should you care about all this? A weaker dollar means higher prices for everything you import: phones, coffee, clothes. Higher government borrowing costs mean higher interest rates for your mortgage, car loan, and credit cards. Less government money for schools, roads, and health care. More spent on debt. Globally, a shaky U.S. economy slows growth everywhere, costing jobs and innovation. Trade wars make things worse. No one wins, everyone pays. The era of stable, American-led prosperity is over. The world is entering a more chaotic, unpredictable phase. Even your lunch is affected. Its price and ingredients depend on a stable global system. The drama of global finance is now on your kitchen table.